L. Calculate and interpret accounts receivable turnover, inventory turnover, and accounts payable turnover. Accounts receivable turnover measures how efficiently a company collects credit sales. It is calculated as net credit sales divided by average accounts receivable. A higher ratio indicates faster collection and effective credit management, while a declining ratio may signal collection problems or lenient credit policies that could increase bad debt risk. Inventory turnover evaluates how effectively inventory is managed. It is calculated as cost of goods sold divided by average inventory. A higher turnover suggests efficient inventory control and strong sales, whereas low turnover may indicate overstocking, obsolescence, or weak demand. Accounts payable turnover measures how quickly a company pays suppliers. It is calculated as net credit purchases divided by average accounts payable. A lower ratio suggests longer payment periods, potentially improving short-term liquidity but possibly affecting supplier relationships. Interpreting turnover ratios requires industry comparison and trend analysis. Extremely high or low ratios may indicate operational inefficiencies, supply chain issues, or working capital imbalances that affect profitability and liquidity. M. Calculate and interpret days sales outstanding, DSO, days sales in inventory, DSI, and days purchases and accounts payable, DPO. Days sales outstanding, DSO, converts receivable turnover into days. It is calculated as 365 divided by accounts receivable turnover, representing the average number of days to collect receivables. Lower DSO indicates efficient collections, while higher DSO may strain cash flow and increase credit risk. Days sales in inventory, DSI, measures the average number of days inventory is held before sale. It is calculated as 365 divided by inventory turnover. Lower DSI suggests efficient inventory movement, while higher DSI may reflect slow sales or excess stock. Days purchases and accounts payable, DPO, measures the average payment period to suppliers. It is calculated as 365 divided by accounts payable turnover. A longer DPO improves short-term cash flow but must be balanced against maintaining strong supplier relationships. Together, these metrics provide detailed insight into working capital management efficiency. Analyzing trends helps identify operational strengths and potential liquidity constraints. N. Define and calculate the operating cycle and the cash cycle. The operating cycle measures the total time from purchasing inventory to collecting cash from customers. It is calculated as days sales in inventory, DSI, plus days sales outstanding, DSO. This metric indicates how long capital is tied up in operating activities. The cash cycle, cash conversion cycle, refines this measure by subtracting the payment period to suppliers. It is calculated as operating cycle minus days purchases in accounts payable, DPO. It represents the number of days the company must finance its operations with its own funds. A shorter cash cycle indicates stronger liquidity and efficient working capital management. Companies aim to reduce DSI and DSO while managing DPO strategically to minimize financing costs. Understanding these cycles supports cash flow forecasting and financing decisions. Managers use these measures to optimize credit policies, inventory levels, and supplier terms. O. Calculate and interpret total asset turnover and fixed asset turnover. Total asset turnover measures how efficiently a company uses all assets to generate sales. It is calculated as net sales divided by average total assets. A higher ratio indicates effective asset utilization, while a declining ratio may suggest underused capacity or excessive asset investment. Fixed asset turnover focuses specifically on property, plant, and equipment. It is calculated as net sales divided by average net fixed assets. This ratio evaluates how effectively long-term productive assets generate revenue. Interpretation requires context and industry comparison. Capital-intensive industries typically have lower turnover ratios, while service companies often exhibit higher ratios due to lower asset bases. These activity ratios link operational efficiency to profitability. Efficient asset utilization supports higher returns and stronger competitive positioning by maximizing revenue generation relative to invested capital. P. Calculate and interpret gross profit margin, operating profit margin, net profit margin, and EBITDA margin. Gross profit margin measures the percentage of revenue remaining after deducting cost of goods sold. It is calculated as gross profit divided by net sales times 100. This ratio evaluates production efficiency and pricing effectiveness. A declining gross margin may signal rising input costs, pricing pressure, or inefficient operations, while a stable or increasing margin indicates strong cost control or competitive positioning. Operating profit margin measures operating efficiency before financing and taxes. It is calculated as operating income divided by net sales times 100. This ratio reflects management's ability to control operating expenses such as selling, general, and administrative costs. It highlights core business performance, independent of capital structure and tax strategies. That net profit margin represents the percentage of sales that translates into net income. Calculated as net income divided by net sales times 100, it incorporates operating performance, financing decisions, and tax effects. It indicates overall profitability and sustainability. EBITDA margin evaluates operating performance, excluding non-cash expenses and financing structure. Calculated as EBITDA divided by net sales times 100, it emphasizes cash-generating ability from core operations. Analysts use it to compare firms across industries and capital structures, but it should not replace net income analysis. Calculate and interpret return on assets, ROA, and return on equity, ROE. Return on assets, ROA, measures how effectively a company uses its assets to generate profit. It is calculated as net income divided by average total assets. ROA evaluates overall asset efficiency regardless of financing structure. Higher ROA indicates stronger operational performance and better resource utilization. Return on equity, ROE, measures profitability from shareholders' perspective. It is calculated as net income divided by average shareholders' equity. ROE reflects both operating efficiency and financial leverage, showing how effectively management generates returns on owners' investments. ROA and ROE should be analyzed together. A significantly higher ROE than ROA suggests substantial financial leverage. While leverage can enhance shareholder returns, it also increases financial risk, making balanced interpretation essential for strategic financial management.